Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, we're going to be talking about dividends. It's something that I've talked about in the past, but I keep seeing these YouTube videos about high dividend yield stocks to invest in now. And then I started to see videos talking about how you should live on your dividends in retirement. And as you know, we talk a lot about not only retirement in the future in this channel, but retirement like right here and now. And it's an important topic, and so I want to address it today. And we're going to cover three things as it relates to dividends. And I hope to convince you, my goal today is to convince you of three things. The first is that dividends from a stock or stock mutual fund are fundamentally different than interest you would earn from, say, a bond or a savings account or a CD. And that's true if the yield, dividend yield on the stock and the interest on the bond are identical and it's generating the same amount of income. Those two things are fundamentally different. That's the first thing I want to convince you of today. I'm going to try. That gets us to number two, and that is when a dividend is paid, it affects the price of the stock that pays the dividend, or if it's an ETF or mutual fund, there's an effect on the price of that investment when a dividend is paid. I'm going to actually show you that in black and white in today's video. And then we're going to get to this idea that I've heard recently, in part in response to the video on the bucket strategy that I released a week or two ago. And that is this idea that dividends can protect us from bad market returns in early retirement. It's called sequence of returns risk. It's the risk that, you retire and then the market just crashes and it's ugly. And the idea is, we'll just live off your dividends if you have them, if you have a good dividend yield in your portfolio, maybe a little bit of interest, not much these days, right? But, thank goodness for those dividends. And then we don't have to sell our shares. And it sort of protects us, maybe not forever, but hopefully get us past the bad market. My goal today is to convince you, or at least explain to you, why I don't believe dividends protect us at all from the sequence of returns risk. So that's my goal. And so let's dive right in. First thing, stock dividends and bond interests are fundamentally different. And I want to begin with, a hypothetical. Imagine that you have $1,000 in a savings account and you get a call from the bank CEO and she says, you're just a wonderful customer. We love you here. And we're going to send you a check for interest, $100. Now that's 10%. That's just crazy in today's market, but you're thrilled. And sure enough, the next day you get in the mail a check, $100. It even says in the memo of the check, interest, and you're thrilled. But then you start to think, that is a lot of money, 10%. I mean, no bank pays that. And so you get curious and you log into your savings account and you see that your $1,000 is now marked down to $900. You only have $900 in your savings account and you're thinking, wait a minute. Did they just send me my own money and call it interest? Is that what happened? So you call the bank CEO and she goes, yeah, that's right. That's how we do things here. Now, of course, that's fortunately not how interest on a savings account or a certificate of deposit or even a bond works, right? When you get interest, it's based on the principal amount of, in this case, a savings account, and it's money that the bank gives you. They don't take it out of your account. It's over and above, in this case, the $1,000 that you had in your savings account. But what if I told you that when it comes to dividends, that's exactly what does happen. All you're getting is some of your own money back. You're not getting any new money. You're getting money that you already owned. All right, now I know that may sound crazy, but that's exactly what happens. And it kind of gets us to point number two. When a stock pays a dividend, let's say it's 50 cents a share, the value of your shares actually gets marked down. The exchanges actually go in, it's following what's called an ex-dividend date. And actually, I guess I'll say artificially, it's like when the markets are closed, they kind of go in at night and secretly reduce the value of your shares by that 50-cent dividend. They do that whether you're investing in individual stocks, a stock ETF, or a stock mutual fund. And what I want to do today is actually show you what that looks like. So let me go to the monitor. Here we go. We're on Yahoo Finance, and I'm going to pull up Bank of America. I own shares of Bank of America. In fact, just a few days ago received a dividend. So this has been on my mind. And what we're going to do is we're going to go to the historical data. It's right here. And this shows us the historical price of, in this case, Bank of America. And let me just make it a little bigger for you. See if we can do a little better. Here we go. And you can see it for each day. It has the open, the high for that day, the low, the close, and then this pesky little thing, adjusted close. Well, as you can see, most of the time the close, in this case 38.78, and the adjusted close are the same. And as we scroll down, you'll see, yeah, they are all seem to be the same. So maybe this adjusted close doesn't mean anything. Wait a minute. What the heck is this? Well, that's the 18-cent per share dividend that Bank of America paid out June 3rd. And if we go to the date right before that, we can see, wait a minute, the close, 42.94, is in fact different than the close, or the adjusted close of 42.76. And we can pull up my trusty calculator and let's just put the numbers in just to make sure we're looking at the right thing. And sure enough, we subtract 42.76 from 42.94 and we get 18 cents. So they took our shares, they gave us the 18 cents and took it away in the share price. Now, of course, the next day it starts trading in the opening. It starts to fluctuate, obviously, as it does anytime the market's open, and it closed at 43.25. And frankly, that's one of the reasons we often don't notice. You're talking relatively small amounts of money, a 2% dividend that gets paid out quarterly, typically. It's just 0.5% each quarter. In this case, for Bank of America, it was 18 cents. The next day it opened up and starts trading right away. I didn't even notice. I went in several days later to look at this on Yahoo Finance. So it happens and we don't really even see it, but we have to remember that when a dividend is paid, it reduces the value of the share. And so it's just like that fictitious bank CEO that mailed us our own money in the form of an interest payment. That's exactly what happens when a company pays a dividend. And if you think about it, it makes perfect sense, because how does a company pay a dividend? Well, they take a bunch of cash they have on their balance sheet and they give it to shareholders. So if they're going to pay out whatever, call it $10 billion in dividends or whatever the amount is, that's obviously going to reduce the value of the company. Now, I showed you this with an individual stock, in this case Bank of America, but I also want to show you this just quickly with an ETF and a mutual fund because it's the exact same thing. So let's go back over to Yahoo Finance and we'll look at, we'll do Vanguard's S&P 500 ETF. And we'll go to the historical data. And you can see it looks very similar to an individual stock with open, high, low, close, and adjusted close. And yep, they paid just over $1.33 in dividend. And here you go. You can see the change right there. I won't do the math, but trust me, it all works out. And we can see the same thing with a mutual fund. The numbers are a little different. And we'll take a quick look at it. A mutual fund gets repriced only once at the end of the trading day. So when you look at the open, high, low, close, and adjusted close, you can see they're all the same. Because the way a mutual fund works is they wait until the market closes, they calculate the price of all of the stocks or bonds, if it's a bond fund that they own, calculate what's called the net asset value of that fund per share. And so all of the numbers straight across here are always the same. And in fact, I'm recording this before the market closes on July 8th, and you can see numbers aren't available yet. They won't be available till, 6 p.m. Eastern time or so tonight. But to our point, there's our dividend, right? June 23rd, and sure enough, it lowered the price of the share. So, you've probably heard a lot about dividend investing. Like I said, I've seen a lot of videos on YouTube by some very impressive people with lots of fancy letters at the end of their name talking about why you should invest in high dividend yielding stocks. And the thing I want to impress today is that dividends aren't free. It's not money over and above what you owned before the dividend was paid. And in fact, the belief that it is known as the free dividend fallacy. It's a concept that says effectively, investors see dividends as free. They don't appreciate that when the dividend is paid, the value of their stock or their fund goes down. That's in part, I think, because the number of shares we own doesn't change. We're not selling anything, and so it doesn't feel like we've made any changes, right? And because it's a relatively small amount of money, we might not notice it. And so they've come up with this concept, the free dividend fallacy, but it's an important thing to keep in mind. Dividends reduce the value of the stock or fund that you have. And let me quickly show you the paper that came up with this idea, not the idea that dividends aren't free, but they coined the term free dividend fallacy. Let me make it a little larger for you. I will leave a link to this paper below the video. It was published just a couple of years ago from professors at University of Chicago and Boston College. It's a fascinating paper. I'm actually going to just scroll down to the bottom because I think the concluding paragraph is pretty good. Right here. Absent consideration of taxes and transaction costs, dividends are merely another source of profit along with capital gains, and one which mechanically reduces the price of the stock. So see, I didn't just make this up. It's a real thing. Dividends reduce the price of the stock or the ETF or the mutual fund. They continue. They say, however, popular discourse often discusses them as if they are a cost-free stream of income, independent of capital gains. Many investors and commentators, if pushed, will readily admit that any given dividend will result in a price drop. However, they will then make puzzling statements such as claiming that the reliability of dividend payments provides a good hedge against uncertain fluctuations in prices, or that a high dividend yield is valuable when bond yields are low. Boy, haven't we heard that? We've heard that for years now, with bond yields being so low, and they're even going down here in the last few days, which is almost hard for me to wrap my mind around. But we hear it time and time again, go after those high dividend paying stocks because yields on bonds are so low. Can be a huge mistake. The paper goes on here at the end. A better understanding of the relationship between dividends and price changes would help investors appropriately characterize their profits on each position. How best to teach investors about the proper role of dividends in finance remains an open and interesting question. Well, here I am. I'm the guy. I'm going to try and do my best. So, what have we learned? Interest on a bond and dividend on a stock, they're fundamentally different. When you think about a dividend, I want you to remember that little story about the bank CEO paid you interest in the form of just giving you your own money back. That's effectively what happens when a dividend is paid. Why? That gets us to point two. When a dividend is paid, the value of the stock or fund is, as they pointed out in this paper, mechanically reduced by the amount of the dividend. And that gets us to point three, and that is this idea that dividends are sort of a safe way to deal with, frankly, the fear of running out of money in retirement. And I know firsthand that fear can be very, very real. And in particular, this idea that, yeah, the market may crash, it may go down by 50%, but boy, if you're getting those dividends, they're coming in regularly, that will protect you. So for that point, I'm going to go to the digital whiteboard, and I want to imagine two portfolios. We'll call one of them the dividend portfolio, right? And we'll call one, I don't know, the non-dividend portfolio. Not very creative, but I think it gets the job done. So there we go. And we're going to assume they each have $1 million. And we're going to actually have our worst fears, at least for those of us in retirement, I guess for anybody investing, our worst fear, we're going to lose 50% in 1 year on both portfolios. Think 2008 into 2009. So, it happened not that long ago. So what are we left? Well, even this English major can do the math. We're left with 500,000. All right. Now, let's assume that our dividend portfolio, we'll give it actually a heavy dividend. We'll say it's 4%. At $1 million, it was 4%. The market now, the S&P is below 2%, but whatever, we'll assume 4%. And we're going to give ourselves another assumption to help out the dividend portfolio. We're going to assume that when the market crashed, the actual amount of the dividend stayed the same. That companies didn't cut their dividend. We know that in really dire financial circumstances, companies do cut their dividend. Not of course all companies, but it certainly happened in 08, 09. We can all go back to the Great Depression, and dividends were cut significantly. But you know what? We're going to give the dividends the benefit of the doubt. We're going to assume that the dividend, which would have been what, 4% of a million, is 40,000. So we're going to assume that even when the market goes down, it's still going to pay 40,000, which would make the dividend yield actually 8%. So the dividend yield went up, it doubled, right? But that's just because the price went down. The actual dividend, 40 grand. And so we're in retirement, and our dividend portfolio is probably feeling pretty good because they say to the non-dividend person, you got to sell your shares in a bad market. I don't have to because I'm going to get 40 grand. Well, yeah, that's true. You're going to get 40,000 in dividends, right? And this person, we'll call it dividends here. Yes, my handwriting's terrible. This person's going to get the big goose egg, nothing. But so what are they going to do? Well, they're going to have to sell $40,000 worth of stock. So they're going to sell 40K to spend in retirement. So what are they left with? Well, they're left with $460,000 in stocks, right? What's our dividend investor left with? Well, they're left with $460,000 in stocks. Now, they didn't sell anything, but as we know, when companies or funds issue dividends, in this case 40,000, they mechanically reduce the price of the investment by the same amount. So what's interesting about this is the dividend investor will have more shares, right? Because they didn't sell any. We'll just make up a number. We'll assume that they had 1,000 shares of whatever. It doesn't really matter. Our person over here had to sell some shares, and I could do the math, but I'm not going to. I'll just say they've got 900 left. I'm sure that's wrong, but for our purposes, the actual number doesn't matter. But here's the thing. The number of shares is irrelevant. They both have $460,000 in stocks left over. One, after receiving a $40,000 dividend and seeing the price of their shares go down, and the other, not receiving any dividend, but having to sell $40,000 worth of stock to generate some income. They end up in the exact same position, and I would actually argue that the non-dividend payer is in a better situation. Why? Well, a couple of things. They have complete control over the amount. They chose to sell $40,000 worth of stocks, and they chose the timing. But both of those are in their complete control. Maybe they only needed 35 one year, so they just sell 35, or the next year they need 42. Or maybe they don't need to sell at a particular time and they can wait 3 months. Our dividend investor has no choice. I can't call up Tim Cook and say, hey, Tim, can you up the dividend or hold off for a couple of weeks? He's not going to take my call. As a minority investor, which is what we all are in public companies, we have really, as a practical matter, zero control over the dividend policy of a company. So we have no control here. The second advantage that the non-dividend portfolio has is in taxes. Now, if these are both in retirement accounts, traditional or Roth, then this doesn't apply. But if you have some money in a taxable account, then with some exceptions, you're going to be better off selling shares than receiving dividends. Now, assuming you've held the investments long enough, and these are qualified dividends, you've held everything for more than a year, the actual tax at the federal level is probably going to be the same. You're going to be treated as long-term capital gains. The difference is, with the dividend, all 40,000 will be treated as taxable gains. However, when you sell shares, in this case 40,000, you don't have to actually pay tax on that 40,000, assuming you have some basis, assuming you paid something for these shares however long ago it was. So if your basis, for example, was 250K and you've got 500 valuation in the account, you're actually only going to pay capital gains tax on half this 40,000 or $20,000. So there are a couple of really important advantages to the person who sells shares to generate income in retirement as compared to someone who relies on dividends. Now, at this point, I know you're probably saying, Rob, wait a minute, my head hurts. I've heard forever that dividends are like the bomb. It's just everything, dividends, high dividend yields. What's going on here? And by the way, if dividends can't save us from the sequence of returns risk when we're not selling any shares, what in the world does? It's a great question. And here's the thing. If you go back to something like the 4% rule, remember Bill Bengen, 1994 paper, he looked at total return. He didn't elevate dividends to some special, I may edit that out. Anyway, some special, godlike status. He also didn't demean them and say, I don't want any dividends. He just said, you know what? I'm just going to invest for the market into the market as a whole. I'll get some dividends. That's fine. I'll get some capital appreciation. I'm going to look at this as a total, on a total return basis, both dividends from stocks, interest from bonds, and capital appreciation. And that's how he came up with the 4% rule. But here's the thing. The way we deal as best we can with the sequence of returns risk in retirement is rebalancing. In the example that I gave you, and we can go back to the now completely crazy whiteboard, we only looked at our stock portfolio. We're no doubt in retirement going to have bonds. We might have a 50-50 portfolio, 60-40, 70-30. But the point is, in a case where the market drops by 50%, what are you going to do presumably at the end of the year, at least once a year? Well, you're going to rebalance. Now, in this case, we can make some assumptions about what the bond market did. Maybe it went down a little bit too. It's certainly not going to go down 50% along with stocks, at least based on any historical basis. It's not going to do that. But we're certainly going to be rebalancing. What's that going to cause us to do? Sell some bonds and buy some stocks, which is exactly what we would want to be doing in a down market. That's probably the best we can do, at least of a few things, to deal with the sequence of returns risk. The real takeaway, though, is that when it comes to selling stocks, you should view a dividend as selling stocks. I know it doesn't feel that way because you're not actually selling the shares, but what you are doing is getting money and seeing the value of the share, the ETF, or the mutual fund go down. So dividends in retirement do not protect us from the sequence of returns risk. Dividends are not free. When a dividend is paid, it lowers the price of the stock or the ETF or the mutual fund that pays it. You can see that right in Yahoo Finance with your own investments if you want to look them up. Now, I want to finish by saying this. I don't hate dividends. In fact, dividends are extremely important. They're just not important for a lot of the reasons you may hear on other YouTube channels. Here's the thing. We want management of companies we're invested in, whether directly or through a mutual fund or ETF. We want them to do smart things with our money. And yes, it's our money. We're part owners in Apple, Tesla, Google, whatever. We want the managers of those companies to do smart things with our money. If they can reinvest profits and get a good rate of return, that's what we want them to do. If they can buy back shares at a reasonable price, another good thing to do with our capital. For many companies, though, having considered all of those possibilities, they still have money left over that they don't really have good use for. What do we want them to do? Give it back to us, because we can put it to use. Whether we reinvest it in some other investment, maybe we even reinvest it in the company or fund that paid it to us, that's certainly possible, or it's certainly reasonable to spend it in retirement, primarily because of the tax consequences. If you have a taxable account and you receive dividends, you're going to pay taxes on those dividends, so why not spend them anyway? So I certainly don't hate dividends. I'm just also not in love with them. I recognize them for what they are, a return of something I kind of already owned. Well, I have no doubt this video is going to receive a lot of comments. So just please be kind. Happy to hear anything you have to say. If you think I'm wrong, love to hear about it. Just leave the comments below the video. If you have questions, I'll do my best to help you out. I will leave links to the research I mentioned, and when I get it done, an article on this very topic as well. Until next time, remember, the best thing money can buy is financial freedom.